Okay, let's get rolling. Welcome everyone to the April 21st edition of the Quaranteam Finance Chats. Thanks for joining us. We're looking forward to another great chat about the COVID situation and how everyone's responding to it. Hopefully we'll have some great chats and discussions. The agenda today is, as usual, we're going to go through the news. We're going to talk through some top tips that we've got you thinking ahead. And we're going to get into a lesson, bring in some expert opinions and advice, and we're going to do some Q&A. Joining me on the call today, so I should introduce myself. I'm Ian Rogers. I'm the founder of Entreflow Consulting Group. Been doing this since 2012, helping small businesses, and I had my own startup, which I grew and sold, and then went into consulting full time. I've got Kern from Ashdown Capital on the line, and another Ian. Yes, the Ians are taking over the world, from Hub Insurance, and he's joining me on the line again too. Colin is the community leader for StartupVancouver, a chapter of Startup Canada, and he often joins us on this. Hopefully he will join us in a few minutes when he's available. But why don't I turn it over to you, Kern, so you can introduce yourselves a little bit to the group assembled on the line.
Okay. Yeah, my name is Kern Chiu, and I am a commercial capital advisor with Ashdown Capital. I've been there for about 2.5 years, and what we do is essentially arrange capital financing, specifically debt, for entrepreneurs and business owners. So that's what we do right now. We've been around for about 2.5 years. My past background is I'm an ex-banker, commercial banker for 16 years at a major bank. In there, I did adjudication and leading a team in the commercial loan space, and also spent 5 years in sort of the insolvency credit collection space in the bank as well. So I've been both sides of the table with the bank side.
Sounds good, Kern, and we're looking forward to hearing some of your stories from the insolvency days, so that we can learn how to navigate those waters, keep the banks on our side when things are maybe not going as smoothly as originally planned, and still recover from that. Ian, can you say a few words about yourself and your background?
Sure. So Iain McCartney from Hub International. I have been in the insurance racket now for a decade, come this May, which is a long time. So how things go by. I'm an account executive, which means I am the frontline individual who speaks with business owners and individuals to protect their assets as well as liability exposures, and just continue helping businesses run fluidly while being fully protected with insurance. Hub International, my brokerage, is the 5th largest brokerage in the world now, I believe, the single largest in Canada. And there isn't a single problem in the insurance world we have not come across. In fact, I think we've invented a few of our own just for fun as things have gone by. But we can solve damn near any problem when it comes to insurance.
Sounds good. Thanks, Ian. And I'm sure you've seen some horror stories when things go wrong with business too. And we're looking forward to hearing from you about navigating those waters and how insurance can help and what people need to be thinking about in these kind of times.
Yeah.
Okay, a little bit more about Entreflow. So we're a small firm, boutique firm, I'd say, 18 people. We focus on small and medium-sized businesses. The commonality is that they're growing. They've got big plans for the future. Obviously, a lot of them have had a bit of a setback or need to do some replanning. But we help with accounting and finance. So we're a CPA licensed public practice firm. So we can do taxes and issue financial statements and all that, and offer CFO services. We do HR management. So acting as an HR manager, for instance, if a company needs to hire people or put in programs in place, or even lay people off. And finally a little bit of marketing strategy and execution work. That's my background. Okay, the news. So we have some good news to share today. The CEWS, Canada Emergency Wage Subsidy. The bill passed through the Senate over the weekend. I think it was Saturday. It still needs royal assent, but normally that's a bit of a formality here. So the CRA and the government are saying that they're going to open up the applications on April 27th, and those are going to be available through the My Business account. We've got a link in here, which you'll get when you when we distribute the slides after the meeting, to a site on the Government of Canada website where you can calculate your benefit to see what your benefit might be. You can enter all kinds of things like number of employees and different kinds of criteria, and it'll show you what your benefit might be at the end of the day. Another update is that as of mid last week, the people who wouldn't normally have qualified for the CERB now can if they're making less than $1,000 a month. So before it was you earn nothing. Now if you're still earning just a little bit of money, then they'll give you some more. The CEB applications are open at most commercial banks. So this was recent news. So last Thursday, they reduced the minimum eligibility requirements to qualify for this loan. Previously, it was payroll had to be over 50K of payroll in 2019. And some of us contacted the government and said, hey, well, you know, there's a lot of startups who weren't paying themselves salary or grew a lot in 2019. So can we lower that threshold a bit or change it? And they responded by reducing it to 20K of payroll in 2019. So you can still apply for that through your commercial bank. We sent out the links to those pages on the recording for last week's session, so go ahead and check that out on our website if you haven't already talked to your bank. They may still, when we checked on Friday, some of the banks were still updating their portal to reflect the change from 50 to 20K. So give them maybe another day to correct that if they already haven't. Next is the government has put together a Wellness Together program. This is to help people with, well, mental health problems. Everyone's in a lot of stress, and so the government's put this out here. You'll have the link into that. And we're going to talk a little bit more about mental health and the portal on Thursday in our HR chat, so stay tuned for that. Last item is about rent. So we had this question come up a couple times on previous chats. We do have news on the Canada Emergency Commercial Rent Assistance Program. It's complicated. I'm not going to go into the details here, but you can have a look at the CECRA announcement that the government put out there. And also, many small businesses are looking for assistance from the province as well. And so if you want to join that petition, this is a nice convenient link so that you can send a letter to your minister to say, hey, we'd like some help with commercial rent. All right. Those are the news. Any questions? Any comments from the other panelists also?
Hey, Ian, a quick question for you.
Hey, Colin.
With regard to the $20,000 on payroll, if you are, in our case here, with being a partner with our corporate entity, we took down draws, if you will, dividends, or we invoiced more as consultants through our other sole proprietorships. Would that still qualify, or do you have to be registered as an employee with payroll for that to kick in?
Yeah, unfortunately, it is as an employee with payroll. So we've had this question quite a lot, especially before they reduced it, to people who were just under the threshold and wanting to know how things are handled. This is a tricky area. So you don't want to fiddle around with your numbers too much. And we're trying to get a consensus from the accounting community on this about what's to be done. Some founders have just sort of informally drawn monies from the company, written it against shareholder loan throughout the year, and then have not even yet completed their filings for what that all was. And maybe they have an intention to continue on paying themselves on payroll this year. So they've got some choices to make, and it's not clear about exactly how to handle that. And I don't want to give general guidance, but I'd rather say if you've got a situation which you're trying to figure out how to deal with, and it's not going back and trying to change the past, it's just more so trying to figure out how to deal with this current situation, then come talk to us and we'll help figure it through. I would advise against putting yourself on payroll just to get this and then taking yourself off payroll again. You don't want to do that kind of thing. Cool. All right. It looked like we had another question from the line, but I'm not quite sure. Aislinn, do you want to unmute the mic so in case anyone wants to jump in and ask a question, they can do so? Okay.
I heard something.
Yeah, a question from the line.
I'd heard that dividends are allowed, but not draws. Is that correct?
I can't confirm that. I didn't hear that dividends are allowed,
Okay.
but I didn't hear that myself.
Okay.
Ian, I did see there was a question as far as IRAP funding, and that has changed. I did post on all of our Startup Vancouver social channels the update. We have an advisor through some of the other work that we do, and she provides updates on almost a daily basis. So I did provide a little bit more about that, of what's actually coming down the pipe with that. I don't know if you've touched on that already before I jumped on the call, but there certainly are developments that they are quickly pivoting to realizing that the traditional IRAP program and funding funnel is not working right now. So they're doing some interesting things too. Once again, it comes down to payroll, my understanding, with that, with what you're actually doing, whether you already have or you're putting on payroll. Once again, the part of putting people on payroll in order as R&D in order to get that, don't quote me on that. I'm not an expert in this area, but I know it ties in again to having people that are staffed and salaried. It's more as a job creation or job retention stimulus through IRAP. So that's worth having a look at too. And anybody that's not following us on Startup Vancouver, you can go through our feeds because, like I said, I put that on all our social channels.
Sounds good. Thanks, Colin. Yeah, thanks for bringing that up. I had forgotten to put that on, so no, you didn't miss us covering that. It's just that I just missed it. So there are those developments, and I'll make sure that we share those links as well on the summary of this session. Seems like we had one other question on the line about exiting the subsidy through my rep account. Okay, so I see. So if you wanted to work with your accountant, could they help you access this? And yes, it seems that that would be possible as well. So you can approach your accountant or Entreflow if you're with us, and we can help you access the wage subsidy. Okay. And I'm going to see if I can get a quick answer on whether or not the dividends are allowed versus draws for the CEBA as we're talking. And if not, I'll try and answer it after the session. All right. So next little section is our top tips on risk reduction. So the theme of this week is, well, I don't want to say crash and burn, but it's more so looking at risk. We're in really risky situations. We're obviously looking for the optimistic outcomes, but also we should be looking at ways to reduce risk. So let's take a look at what happens when things go wrong. Let's take a look at how to avoid those things, and hopefully we'll all come out stronger from that exercise. So the quick summary is different types of risk. There's financial risk. There's risk in terms of customer markets. There's employee risk, or built into the operations risk, and just another category which I'm calling other legal risks because I couldn't come up with a snappy name for it, but I'll try and go through some of these guys. All right, so market risks are the ones that are really external to you. You cannot control that. Everyone closed up their retail stores, and if your customers were retail stores and they can't do business, then oh whoops, now you can't do business with them anymore. But there's something to be said, I think, for having a bit of diversity in your revenue streams. So this could be multiple revenue streams, could be going after more than one market, or having more than one product or service offering that you can provide, such that if one of those things dries up, then you still have the other ones to fall back on. And this is something that we see quite a lot when we're when investors are looking at pitches and business plans, is they're looking for, yeah, you've got something, but also there's potential that you're going to have multiple revenue streams. And there's two reasons for that. One, it's potential for faster growth, and two is it's risk protection. This seems to fly in the face of the common marketing wisdom that you should niche, that you should really hone in on one thing and not try to be everything to everybody. And so that's hard to weigh out sometimes. You don't want to try and do too many things at once, because then you lack focus. So how do you balance those things? And I think the answer there is do niche, do pick the thing that you're really good at, but see how it can apply in more than one way. So maybe choose 3 to 5 different subsegments of the market that you're going to go after, or 3 to 5 different kind of product or service offerings that you can go after. There's not an exact number in there, but see how you can balance things out. So that you're not faced with just one type of customer. Maybe all of them are hit by something, or a new legislation comes in. This is not just COVID stuff. This is future facing too. Maybe a new legislation comes through and means that they can't do business in the same way they were doing businesses before, and now your whole industry is wiped out. So try and diversify a little bit of that. The other thing is about quality control. So this is really about how you're perceived in the market. So this is marketing. If you lose sight of quality of delivery, if you're a service company, or quality of product in these kinds of times, then that can really impact your brand. I think a lot of us will remember the story of Lululemon a few years ago with their see-through yoga pants. And man, did they take a big hit for losing sight of quality control when their brand was built on being a quality product. And they were able to recover from that, and that's been a good story since then. But it's just a warning in these times where things are a little harder, that quality is important. So do focus on quality of delivery. It's going to be a lot harder to win those customers back, certainly in these times, if you let that slip. Next item is financial risk. So the one problem that entrepreneurs and small business owners face is the prediction trap, the optimism bias. We as humans typically think that things are going to be better in the future. Or we think that many things will continue on as they are. And that's okay. As healthy dose of optimism is important, but it's also important to sort of get into your rational brain and say, okay, what if? What if this went wrong? I mean, the key thing to reducing risk is to consider what could go wrong and then putting some plans in place to fix that. So when we're talking about making plans and forecasts, is making sure that we're mapping out scenarios that are less optimistic and seeing what could happen there. Little point on this as well is about cash. So a general sort of word of wisdom is to have some cash on hand to see you through a time period where you're maybe not making so much revenue. So that may be, depending on the nature of your business, plan out 3 months of cash runway where you could continue operating even though there's no money coming in. And that should set you up with enough cushion. I know when Bill Gates was building Microsoft, he was obsessed with getting this number up to 1 million, 1 full year of operating runway without any revenue coming in, so that he was certain that he could continue operating. So that's one side of the puzzle, and then the other side of the puzzle is, well, if you need to borrow, you can build that up by savings, but the other way to have cash is by getting debt. So how do you know how much to borrow? You don't want to have too much debt, because then you have a debt load that you have to service, and that's going to eat away at that cash. So there's a little bit of a balancing act that you have to do there. And I've been talking for a few minutes here, so I'm just going to pause and see if anyone else on the panel wants to jump in on these items.
Well, hey, I'll go first here, Ian.
Go for
it. Especially on the too much debt versus too little cash here. It is just so important for entrepreneurs at any stage, whether if you're still at that ideation stage, you still don't have a product in market yet, or you're prototyping, or you do have a couple of customers. It's just so important now just to keep things as lean as you possibly can. I know you've touched on this in previous finance chats that we've had, just as far as look at what's going out the door right now. Look at all the services you have, things that you have as far as software, things you don't need, just even suspend those or just trim those down. Is just so important on that end, to stay as lean as you possibly can and just do some other things manually while you can. But on the issue of debt, if it just means that you need to take a deep breath and perhaps as you pivot with what you're doing, not look at it, well, maybe not pivot in this case, but kind of slow down a little bit as far as your runway, and then look at other areas that you need to, whether it's in your business related to what you're doing or something completely different. I use the analogy of sometimes as an entrepreneur, if you're going around the racetrack at 300 miles an hour, it's okay to pull into the pits. Right? And if pulling into the pits is the metaphor for finding other ways to extend your runway, whether it's in regular times or even during these COVID pandemic times, that's okay. There's no shame attached to that. There's no stigma attached to that. If that's what actually is a means to an end, as that first horizon of growth, meaning how do I put food on the table, pay my rent, pay my mortgage, all those things we need to do, that's okay. And that also will tie into the mental health piece that you're talking about. Also, that anxiety that goes with that. Don't think you need to continue to go on at the rate that you are. You can, give yourself a bit of a break. Take a deep breath and focus on generating cash in other areas, so you don't take on too much debt. I know I kind of threw a lot of the wall there, but once again, just with entrepreneurs, just be kind to yourself. Right? And it's okay if you've got to slow down a little bit and not rush to market as soon as you thought you were going to. That is okay. And we're all here to support you. All right?
Sounds good. We've got a hand up on the line. I think it's Dave.
Sorry, I'm trying to get unmuted. Can you hear me now?
Yeah, I can hear you. Nice to hear from you, Dave.
Okay, finally. I got to acknowledge these sessions. They're awesome, Ian. Thanks for doing them. So can you provide a little bit more specificity around debt versus cash flow? I mean, I would imagine an awful lot of entrepreneurs are, pulling out their credit card and stacking more onto the credit line, obviously at a undesirable interest rate. So can you give us any perspective on how far to let that go before you put on the brakes, or before you, whatever, cease and desist, whatever it means?
I would say that the credit card, using credit cards for operating expenses, it's only really meant to be a very short-term thing. It's a convenience of to pay for things with a credit card. I think you really want to be approaching your financial institution. If you need more, you shouldn't have to carry a balance month to month to month on your credit card. It should be money on, money off. I'd expect the balance will go up and down a bit, but you certainly shouldn't be pushing to 90% of your limit on your credit card. Before you get to that point, certainly right now is a good time to talk to your financial institution and see if you can get a short-term line of credit. If you can get onto the Canada Emergency Business Account, CEBA, then that might be a good thing to do right now. And then, like Colin said, reduce those expenditures. So credit card debt, not a good idea. But also, there's something to be said for having to completely stop and maybe close your business. So you don't want that. There's a risk of doing that if you just say, I'm not going to spend anything, losing all the momentum that you have. So it's going to be a bit case by case. I wonder if Kern, if you have any thoughts on this one.
Yeah, I definitely do. Just listen to what
short-term debt.
Yeah, so just listen to what Dave has to say. Yeah, it's and probably this will go into sort of what I'll talk about a little bit later, is that in a department that I work for in the bank in the collection side, is that it's a fine balance in using your credit cards as a way of financing. Really, that should be your last resort. I know a lot of people use their credit cards because they want to collect the points for various air miles or points for their various credit card systems, but those should not be the reason why you're using credit through credit cards. There are so many other avenues, like just what Iain said, is first off is to go to your bank, because right now prime is at such a low level, and if you have already some financial borrowings with the bank, it's just a matter of going back to them and just saying we need a little bit more. Ideally, if you also maybe own a piece of property or real estate, there's other ways of borrowing personally through a bank that will be a lot cheaper than using your credit cards to finance that. So I think, if you look at the debt stack of, options to borrow, your credit card would be your last resort, and it would be sort of something that you had to do, like what Iain says, it's an in and out transaction. But there definitely is other ways, and I think your bank is your first step. And if not, there's other avenues that is what you call your second tier lenders, like your BDCs of the world, where they may not even need something that's tangible in security. If they see that there's cash flow in the business, that they're willing to lend on cash flow or on your covenant, if they feel that you've got some worth in your personal covenant, i.e. your personal holdings, they also lend on that, and that a bank will do as well. So I think there's definitely worthwhile to have a discussion just to look at your whole financial picture from your business side of it to your personal side of it, and really look at sort of cheaper ways to borrow.
Sounds good. Thanks.
Well done. Great answer.
Yeah.
All right. Employee risk is next, so I just want to talk about this quickly. You can get into hot water with employees if you terminate their employment incorrectly. They can come back and sue you for improper dismissal. Even if you just change their job description without following the correct procedure for doing that, then that can be a constructive dismissal. So you want to make sure and avoid doing that, paying people their proper severance pay, etc. The next high risk item for employees is safety. And this is really apparent for physical labor kind of jobs, manufacturing businesses, for instance, but can also happen for office workers as well. And certainly as people are now working from home and the situation is all different, we might end up with some different kinds of injury claims, and you have to think about that a little bit. Maybe there's even some businesses that are getting their people to come into the office even though they should be social distancing. I hope there aren't any of those on the line. And that's certainly a big concern for employee risk. Next item is desperation. There may be a lot of desperate or really stressed out people here, and desperate people do stupid things. Don't leave yourself open to fraud or theft from your employees. You're going to need some really good internal controls, especially with lots of people working remotely. It's just your standard ways of working are not going to be a problem. This is a problem. It's not a thing that a lot of employers like to think about. But the most common one is time card theft. Previous business that I worked in, we had in some pay periods, 10 to 15% of the hours claimed were not actually worked. Huge, huge problem. Another business that someone I know worked in had employees actually fraudulent activity, stealing money from the business. So that can be worked around with proper internal controls. Make sure your accounting records are up to date, and you'll see this kind of thing happening in real time. If you don't, then you only find out about it 6 months, a year later when you complete your bookkeeping and catch it all up and realize that there's $10,000 missing. And by that time, it's too late. So make sure you handle those risks, get ahead of those. It would be the worst thing to pivot your whole business, find the new strategy, get things rolling along, and then have an employee wreck it all for you. Next is general legal risks. So I think this is maybe something that Mr. McCartney here would know a little bit more about, but these are just sort of little flags that I put down for what you might want to think about. So if you're pivoting your business and you're going to do the things with different customers in the same market is really very much related, you probably don't need to do very much extra thinking about legal risks. But maybe if you're involving new partners, might want to think about legal risks there, new products, new types of customers. Maybe they're big business and they have different clauses in their contracts that they want to do things as you take on more risk. That's something you're going to want to think about. Certainly make sure that you have an out. Certainly avoid locking yourself into long-term commitments, especially in uncertain times. One easy one to think about is the software subscription expense. Lots of SaaS companies out there, and they're doing a great job. Some of them are less friendly on cancellations, and they might be billing you monthly, but they're not going to let you get out of the contract if you cancel 6 months into your initial 12-month term. So watch out for that kind of thing as you sign up for new things. We all want to move quickly, but we don't want to we don't want to get tied into something that doesn't serve us when we have to be able to pivot and move agilely in these times. Last couple items are where shareholders are not happy. Things have gone wrong in the business or taken a south turn, or you're trying to pivot and they want to go in a different way and then they sue you. So watch out for that kind of thing. And also this may happen with founders as well. So maybe there's 2 co-founders or 3 co-founders, and one of them just doesn't want to be part of the business anymore, or thinks that they're putting in more effort, and then that can start some infighting, and that can scupper the whole thing. So these are risks to look into. There are ways to mitigate and manage these things. And most of it is just look at the fine print, make sure that you're taking a pause before signing on for things. Ask for advice from your insurance professional, for instance, or from your lawyer if it's a contract. And certainly when you're dealing with people in your business, shareholders or other founders, just make sure and write it down. whatever it is that you are doing or that you've agreed to do, make sure that you write it down, even if it's a simple bullet point document to say, okay, yes, I am now going to work full time on the business. You are going to go and try and earn an income elsewhere. And then you're going to return in 6 months. And here's how we're going to handle the equity, et cetera, et cetera. So whatever it is, write it down so that there's no confusion. Any other comments on this one?
Yeah, I got one.
Go for it.
Businesses have been very good at changing with this market. The best ones that change fastest are typically the ones who are going to survive. But we've had some hiccups on my end. So easy examples are, if you're changing your operations significantly, before you commit to it, you have to talk to your broker. Because I have an easy example that's convenient. We had a client who sold laser printers. Laser printers, 3D printers. He sold them to a bunch of people in the Lower Mainland. And during COVID, he wanted to help out, and he couldn't sell these printers anymore. So instead, he started using the 3D printers to manufacture masks for COVID. Admirable. And he wanted to sell it to hospitals as well as individuals. From an insurance perspective, changing from selling printers to selling medical devices and equipment is a humongous liability change. And the insurance company got off risk. They said, we're not covering this kind of exposure. It's just not our expertise. We're not comfortable with it. And so they gave 30 days for the client to get a new insurance provider. Now, that's doable. We can find the insurance provider, but he suddenly saw a huge increase in his cost for insurance as well, because the risk of him getting sued for these masks in such an uncertain time where people are facing such fiscal difficulties is massive. Someone could just claim they used the mask and it failed and they got COVID and sue. Now that is probably a frivolous lawsuit that wouldn't end up paying out, but the defense fees alone are enough to make insurance companies nervous. And my client was blindsided by the increase and by the whole change. So before you commit to that, and it's a huge change, switching your operations, you can't just do it there and back and there and back. Talk to your broker. I know it's unpleasant sometimes, but talk to your broker about it and just see what they think. And if they have to go to the insurance company, it takes a few days or a week, take a breath and wait before you commit your resources to it. So then that way you can go forward confidently.
Sounds good. Question from the line was, won't the Crown backstop the risk? I think this is short answer to that is no. They're asking for help from companies to produce medical equipment and such, but they don't want to, can't deal with all the individual nitty-gritty pieces. So they're just looking for suppliers to serve them in the normal way. Certainly they're going to pay for it. So I think if it's a worthwhile business venture, and you can figure out all the costs and everything for going into it, then that may make sense as a pivot for you. But I don't think that they're going to backstop the risk. If one of your masks or something fails, then that's going to be on you. Okay. And then we had another question about, can startups go into abeyance without bankruptcy, a sort of bankruptcy and insolvency Chapter 11 type action for startups? I think this is I would only guess on this one, so I'm not sure I can answer that question properly. I'm going to guess probably no. I think Chapter 11 type bankruptcy things are a big deal. Lots of legal stuff going on in there, usually for public companies. But that's my impression of it, and I don't know of an equivalent for startups. But I can try and find out for you. Are you considering bankruptcy or a wind-up? I wonder. Maybe you can answer back after if you're willing to share. Any other questions on the topic of risk? I think there was one about the internal theft or employee theft. that I saw fly by on the chat. Nope. Okay, we'll move on.
One quick thing.
Keep those questions coming, guys. It's really great to see them come up in the chat, and we can go through as we see them come up.
One quick thing.
All right, let's go into when things go wrong. And this point, I'll lean on Iain and Kern to take us through some insurance stories. So you're up first, Iain, if you don't mind. Tell us some horror stories. Tell us what we should be thinking about in this kind of time with regards to insurance.
Yes, I'm always a very optimistic person to talk to. So COVID during a hard market, I'm sure a lot of you have had your renewals in the last year, and you've seen rather significant increases in your premium. So before the pandemic hit, the insurance industry is characterized by a cycle. It's a soft market and a hard market. Soft market is a time where the insurance companies are making money, usually from a combination of premium collection and investment returns, and they're joyous. So they're very keen on competing against each other. They're very willing to drop the premium to get new clients, and they're open to taking on new and variety of different risks. As of probably last year is where it really finally hit. We have a hard market. A hard market is essentially the exact opposite of what I just described, and it's more painful. There are increasing rates, low levels of competitions between the insurers, and a reluctance to take on risks. The insurance companies globally, if you believe them, have indicated that they haven't really been profitable in the last 2 or 3 years, especially in the real estate space, and their investment returns have been relatively flat. So a combination of that has caused a huge knee-jerk reaction where rates are going up, depending on your industry, on average of 10%, and we've seen as high as 600%. Just like, and we had a strata that was 1 year old. It went up 600% and caused the condo fees to blossom from $200 to $600 a month overnight. So it's a very difficult space. And then COVID hit, which just made it all that more peachy. So of course, with COVID, a lot of companies, a lot of individuals' revenues have been devastated or will be. It's a very uncertain future we're taking on. The economy is going to take a long time to recover, which means investment returns are still going to remain flat, if not go negative. So now is a very important time for your broker to step up, and the negotiations between the insurance companies and the brokers have become incredibly fierce and long. So we're trying to make pricing affordable for businesses because we know how difficult it is right now. The downside is it's entirely against the insurer's goals of coming back to profitability and making money. Some insurers are more open to this than others. So you need to talk to your broker, see what they're doing for you, and just be aware that your renewals are probably going to take longer than usual, and they're going to come closer to the deadline. Your broker should step in to tell you what they're doing, absolutely, just so you have a heads up and you're in the know. Not all of us do. So if you haven't heard from them, let them know. Just say what's happening, because the uncertainty, even especially now, you want to know what your expenses are going to be. Insurance is no different. It's something you can't get away from. So talking about the depression of that, I'm going to try and help you lower the price of your insurance, because we all want that. I'm going to talk about some basic things because I don't want to take up all the space. But with your workforce working from home, as well as yourself, if you do, call ICBC. They allow you to do remote calling now instead of going into the office, and remove your kilometers to work or your business use. This can drop your premium quite significantly for you and your employees. It'll make you look like a superstar when everyone's feeling the pinch. Relatively easy. Speak to your employee benefits advisor if you have one, because then you can discuss a temporary reduction in your benefits. There is 0 point right now to carrying dental, massage therapy, physiotherapy, any of these benefits that you normally do that are usually quite expensive, because they're all closed. So you can see a huge reduction in that regard. The insurers for employee benefits are also deferring their renewals from 30 to 90 days, as well as increases in premium. So it's something to talk to your group benefit advisor about, because any increase that you have, there's no penalization right now. So if you have to extend your current policy by 90 days, you're not going to get penalized. You're going to go at the same rate you're currently paying. Could be a huge help for when that inevitable increase comes. Maybe you'll be in a better financial position. Hopefully we all will be. You can increase deductibles on your policies. I don't like doing this. It's not a huge reduction in premium usually, but it's something you should pursue, especially if you have the appetite to take on a bigger fiscal loss if you have it. And when you renew, the most important thing right now is be very honest with your revenue projections. Your commercial general liability coverage, along with your business interruption coverage, the cost of it is directly derived from the revenue. So if you've seen a 30 to 40% reduction, or you expect to see a huge reduction in your revenues, tell your broker. There's no point hiding that fact. It will save you money, because we can go back to the insurer and say, look, that $3 million business last year in revenue is now $1 million. We need at least a 40% reduction in your price. And if they don't do it, we'll have to shop it. That position is very beneficial for you guys. And it's definitely something going on. And if you don't know yet, you can also discuss a liability adjustment clause being inputted into your policy. This means that you agree to pay at a certain revenue, but if you don't hit that revenue, you'll get a refund. Or if you exceed that revenue, they'll charge you more when your policy renews next year. It's not going to be a huge solution, but it's a good band-aid on the problem for now. It's definitely something worth looking at. And unfortunately, those are all the only real tips I have for you for reducing your premium. I don't have a magic wand, but that's all I got right now. Big thing is payment deferrals. Insurance companies are pretty understanding. Some of them. Talk to your broker if you're having problems with payments because of cash fluidity. A lot of insurers will agree to deferring your payments for your insurance. You're still going to have to pay at some point, but they can talk about extending it. They can give you a month or two freeze, similar to the banks. It's worth talking about with them. ICBC is also doing as well. It's a personal conversation typically you have with the insurance company, not your broker. So if you want to facilitate that, talk to your broker. You don't have to tell him the unpleasantness if you don't want to. We understand, but you don't have to. So the last one is vacancy. It's a huge issue right now. A lot of businesses are closing. You go down Granville Street, it's a ghost town. A lot of insurance policies have conditions within their wording that stipulated if a building remains vacant for a period of 30 to 60 days, vacant being it's just not occupied and there's no intention of coming back for an undetermined amount of time. That will cause, when that time period is past the 30 to 60 days, whichever is allocated in your policy wordings, your insurance coverage is automatically reduced. So you'll lose water damage coverage, you lose theft coverage, you lose vandalism. There's a bunch of other things. It's the coverage that's left, I'm not a fan of, frankly. It's not very good for protecting you. Many insurers understand that businesses are closing and they are extending that period. So you can get longer than 60 days vacancy. You can get up to 120. I think that's the longest I've seen so far. And they're willing to extend it if this pandemic continues. Again, it doesn't really cost you anything. You're going to maintain your same pricing. You just have to have that conversation. If you don't have the conversation and you suffer a loss because of a vacancy and it's been longer, you're going to be in big trouble. So just have that talk with your broker. Most of the work's on the broker side. It'll take them time to get the answer. So just have the call. It shouldn't take too long. And yeah, in terms of terrible things that have happened directly to businesses, because I know Iain loves these ones the most, there's been an 86% increase in break-ins in the Lower Mainland since the start of the COVID pandemic. Most retail shops, businesses still have a lot of goods in there and they're not open. So it's a great place to steal. We've seen a lot of that. Get stronger locks, get security systems, get water valve closures if you can to prevent water damage. Like, there's a whole bunch of things there. And the biggest one that we're actually seeing is cyber loss. So a lot of unscrupulous people have attacked businesses pretending to be able to help with COVID. They've been the CRA. They just mimic so many different avenues, and they say, oh, well, we can help, but we need this, this, and this. And then they steal personalized data, crack into your system, ask for Bitcoin ransoms, etc. If you don't have a cyber policy right now, and your employees are working remotely, or you're just operating in a different way that relies more heavily on data flow and using your computers, get a cyber policy. They're not very expensive. Usually they can start from anywhere from $500. They can go up to the moon, of course, depending on the limits and what you do. But have that conversation with your broker, because we've seen so many losses related to this, and they're really expensive and hard to fix. When you have a cyber policy, the insurance company will bring in a team to fix everything for you, and it will save you time, money, and grief. For the price of the policy, it's worth it. So just look into it.
Thanks, Ian.
And that's all I got.
I do love hearing those stories, but just more so from learning from other people and learning about mitigating risk. So these are great suggestions. Thank you for that. I'm going to turn the floor over to Kern, and we're going to talk about what happens when things go wrong with your bank. Because a lot of people are fearful about that right now. Maybe they have a loan outstanding and the bank hasn't said anything yet, but they're worried. Yeah. What's going to happen? And I think knowledge of what might happen can help reduce our stress, so that you can understand the process that the bank's going to go through. I'm guessing, Kern, it's not they call your loan and close your business tomorrow on a day's notice. No. Okay. So tell us what happens and how we should manage if things are get tight.
Yeah. So as everyone knows, when you go and enter into a bank, typically they're going to make you sign a whole bunch of security documents, and really those security documents are really the bank's protection to one day, if things don't go right, that they are able to sort of enforce on that security to essentially collect money to repay their loan. So when I was in the office, I was in the bank's insolvency division in 2003, did it for a couple of years. But then the credit crisis in 2008 and 2009 came about, and I was called back into the office. So what I'm seeing right now with this COVID thing is probably going to replicate what happened in 2008 and 2009, when really there was a major credit crisis. People are basically at crossroads of what they want to do, whether it's to continue with business or to essentially shut it down. So typically in the banks, all the big fives, you will typically deal with a bank manager. He's your account manager. He does everything that's, lending money to you. When times are great, times are rosy, he's the guy that's going to basically be shoveling money out into your bank account. When things don't go too right and go wrong or sideways, that's when the banks will transfer your file into a different department, and then you're dealing with a different guy. And you have various names. For the bank, we called it special credit. There's called loss management unit. It's essentially the collections office, where they need to either work out the loan to get repaid, or essentially sometimes it doesn't get worked out and it goes into a bankruptcy route. Definitely a stressful time for a lot of people, but I just wanted to sort of highlight just some key things. At the end of the day, all the banks are human. There's someone that you're dealing with on the other side is a human. And what the banks really would appreciate, and this is kind of where it would stretch a long ways to help you through, what is a very sort of unfortunate situation, is that to communicate to the bank early and often. Typically your bank is your senior lender. They're at the top of the food chain. Whatever comes into your bank account definitely gets paid to the bank first. So always communicate early and often. Another thing to always do is to make sure that your financial reporting is still sent in a timely manner. I think it's human nature that when times are tough, people saying, you know what, my financial statements look crappy. I'm not going to send it to the bank. I don't want to show it to them because then they may do something. Well, the fact that you're not sending it in on a timely basis already sort of will trigger the bank, because the banks all have these internal reporting mechanisms that will spit out a report on a monthly basis that say, company XYZ did not operate as agreed today. They did not send their reporting within the 20th of month end. So already by doing that, you've already triggered something at the bank. So where it ties into community early is to tell the bank. All the banks are expecting that results for most companies are going to look not great. So there's no need to hide the obvious to them. They're going to know that. Next is to be proactive. Have your management team, your CFO, whoever is in charge of understanding the financial analysis of the company, to provide projections. Take your old ones that you cement to them right before you did your annual review. Now send out the revised one. If business is down 50%, show it's going to be down 50%. But then also show them, what might be the light at the end of the tunnel. Like maybe you've got some contracts that are still going to be going through, and what they will look like in 6 months' time. At least it allows the banks to pivot and still support you, whether it's a payment deferral, a loan deferral. That's still something that's all being offered by all the big fives right now. So, you just need to request it. Thirdly is don't provide any surprises. Don't start writing big checks out of your company account by putting it into your personal name. It's definitely not a time where you start transferring assets. If your home was part of the security package and you decide to now, transfer it to your wife's name because you feel like you want to divert the security away from the bank, that's called a fraudulent preference. The courts will reverse all that. If the intent is there to defraud the bank, the courts will reverse it. So it's something that I highly recommend you don't do it, because right then it just puts the bank in a bad position, because then the trust between you and the bank has basically been voided. And that's kind of when the banks decide to take much more of the nice guy approach to more of the mean guy approach. Again, it's also assigning companies into bankruptcy. Typically, your credit agreements will always say you need to provide the banks with any notice of what you might plan to do with the company, i.e., selling it to another shareholder or assigning it into some form of bankruptcy protection. It's always valuable that you need to advise your bank ahead of time. And then a lot of times what we see is understanding, like being a business owner, I know there's a lot of emotions in place, is try to be rational. What we see a lot in our time in that department is a lot of people throwing good money into bad. Business owners are always blinded by, I think I could turn my business around, but it comes to a point where you need to really maybe talk to someone and just realize, maybe officially, the thing is you're flogging a dead horse. Like, you're not going to get this thing turned around. So coming to the realization that, sometimes you just need to realize that maybe the stream's now officially dead, and not to throw any more good money into it is a way to sort of save some of that, much needed cash that you would have.
Cool. Thanks, Kern. And just add to that, and this may sound like a plug, but an external financial advisor, a fractional CFO, a really competent accountant can be a great person to be that rational person, can even interface with the bank for you and with you on those calls or emails, and make sure that those timely financial projections and reports are done, and you can sort of emotionally offload on that person to do the piece and have those conversations rationally. And that's something that our team can do. You had a couple of other slides, but I'm realizing that we're at time.
Sure.
And I think these are the summary of things that you should have if you do want to apply for a loan right now. And maybe the best thing is just to send these out with the slides. And there's a whole bunch of questions that Kern provided, and they're really useful for companies that are looking to apply for a loan right now. So I'll leave those on the slides and share them out after. And just before we have to wrap up, I'll say, are there any other questions or comments for the line? Yeah, it looks like Dave has a question. Go ahead, Dave.
Yeah, Ian, would you mind if we went back to the subject of CERB again?
The Canada Emergency Response Benefit?
Yeah.
Okay.
I couldn't remember what it was an acronym for.
Yeah.
So I think I might have popped you or Helena a message that that they are a little bit more flexible on the qualifying conditions.
Yeah, that's correct. So they changed it midway through last week. It had been that if you're not earning any income, you're not working, then you can qualify for $2,000 per month or $500 per week. And they changed it so that you can earn up to $1,000. So even if you're making still a little bit of money, then you can still qualify for CERB.
But for an entrepreneur, you would need to show some history of income from your business.
Correct. Yeah. So that can be, I think it's only 5K of income in either 2019 or 2020. And that can be any form. It doesn't have to be salary.
Right. So dividends, I think, Colin, you were describing a situation where you're making withdrawals, sort of paying yourself out of the company account. Providing the paperwork is appropriately complete, those would qualify too?
Yeah, you should be fine. And you'd also have to show that you've lost income in this time. We had a question on the line about key man insurance for COVID 2019 or COVID-19. Really good question. Certainly, if one of the founders or co-founders or a key person gets sick and can't work, that's a huge risk on the business. That's a great segue also, because I'm inviting somebody for Thursday's chat on HR to cover people insurance, so employee benefits and key man insurance. So we're going to talk about that topic on Thursday in a lot more detail, and we'll look forward to having you back on Thursday. We can talk about that then. Any last minute burning questions or comments? No? Okay, well then, all that remains to be said is thank you very much, everyone, for attending and contributing. Really appreciate everybody contributing your questions and comments. Special thanks to Iain and Kern and Colin for joining us. We'll continue doing these chats every Tuesday and Thursday, and the longer we go, the better we get. And that's thanks in part to you guys sharing it with your friends, colleagues, peers in your business networks. The richer the conversation gets, the more people there are, the richer the conversation gets, and we appreciate it. So thank you very much, and look forward to seeing you all on Thursday. Bye for now.
Take care.
Thanks.